What is bulletproofing? Well, bulletproofing is what we do here at Radioactive Trading when we take a properly structured position from low risk to no risk. Guaranteed profit to the downside, even if the underlying does the opposite that we were hoping for, while still having unlimited profit to the upside. Is that even possible? Well, earlier we shared two examples from the Fusion portfolio, Ally Financial and ESI, both bulletproof. No chance for a loss, no break even, all profit in all directions. Still opportunity to get more income to increase that status, unlimited upside, and having no fear through earnings. So absolutely, yes, it is possible. But how does it happen? Well, step one, we have to have the proper structure. Control risk to single digit. And this is the November trade from our previous discussion on the hat trick for locking in gains. The proper structure. In that hat trick video, we took a look from CF from November 12th, 2021. In that one, we just waited for the stock to move up and showed you how you can bulletproof your position, get income, and still leave the upside open. But if I had done the trade differently, if I had opened it as a preferred married put from the beginning, on November 12th, we would have bought 100 shares of CF at 64.57. Bought the June 70 put at 11.15. Now this would make my total invested $75.72, but I'm guaranteed to get $70 back no matter what happens. So the maximum I can lose is only $5.72 or 7.7%. Well, why is the risk only 7.7%? We paid $11.15 for that June 70 put option. Can't I lose all of that for a higher risk? Well, when the 70 put was purchased, the stock was trading at 64.57. $5.43 of that put price was intrinsic value. We're guaranteed to get that back. The remaining $5.72 of that $11.15 cost is the time or extrinsic value, which is the true risk. And that would only happen in the worst case scenario if I held the position all the way to June, where all time value is gone, and the stock remained below $70 per share, and I did no adjustments between now and June expiration. But why this particular put? Because it satisfies the three core principles discussed earlier in our low risk to no risk trading video. And this really applies to all options trading structures, not just our preferred married put approach. We want to take advantage of the time decay curve. We want to put time on our side. So we're going to look for a protective put option that's at least 150 days out. We're going to apply the concepts of the at-the-money bell curve. When I look to sell premium with the income methods, I want to be close to at the money to maximize the time value I'm collecting. But I want to buy on the outer wings, in the money and out of the money, and able to pay into a lower time value. This forces the ideal size trade. But can we really bulletproof a position? Just using the power options tools, tracking that CF position from November 12th, we can go into the position analysis view to view rollout opportunities. And with CF now close to $71 per share, up 10% from November 12th, and having purchased that initial put option rather than just the stock, there are almost 5 bulletproof opportunities that are currently available and shown for us in the power options tool. That was income method number 3. It would have allowed us to swap the time value we already purchased into a lower time value closer in to greatly reduce the risk or bulletproof the trade. It is a great play prior to an earnings event, but not one you might want to use depending on your SIGA model for the trade. That's the decision-making process we use in radioactive trading, and the blueprint discusses all 12 SIGA models for the 12 different income methods. Let's take a look at the anatomy of a trade. Were there other opportunities to use income methods during this time period? Absolutely. We see about 4 to 5 opportunities to have gotten income lower the cost basis, and lower that initial risk on the position, even with the stock falling below $60 at one point during this trade and then coming back up in price. 6 days into the trade, on November 18th, CF had moved up to 67.57, a gain of $3 or about 4.7%. We could have grabbed some income right away by looking at the 2-week out 03 of December expiration 70 strike call for $1.05. This sort of creates a collar position. We reduce the initial at risk from 7.7% down to 6.3%, and we still have potential upside on the position and ability to adjust that call if needed. And what starts to happen next? Now we start to get into that decline. On November 30th, 12 days after we would have used maybe income method number 1, CF is down to $60.59 per share. This is down almost $4 from our purchase price, or 6.2%. Our call that we sold is losing value and getting close to expiration. That's a positive to us. The stock is losing value. That's a negative. But what is gaining in value? Our second working asset, that protective put that we had purchased to control risk initially. We can swap the gain in the put to lower the cost basis on the entire trade. We had an initial risk of 587 or 7.7%. We're going to take 105 with that call expiring in just a few days on the 3rd of December. On November 12th, we paid $11.15 for that properly structured protective put, and it's now at $13.50. We can sell to close that, take the $2.35 of profit, but then keep protection with a lower strike put now that the stock has moved down in price against our expectations. This is income method number 9, one of the 4 ways we can manipulate that second working asset in our favor. It has pros and cons and should only be used in certain situations. Again, that's where the blueprint helps for the full discussion of that SIGA decision-making process that we use to apply a particular income method. Our action, we could have sold to close the June 70 put at $13.50 and bought to open a June 62.5 put at $8.70. Remember, the stock's at 60.59, so I'm still on the right side of that ATM bell curve. This reduces the cost for higher upside if the stock recovers. We originally had a cost basis of $7,467 for our collar structure with 100 shares. Now, after this income method, the total cost is down to $6,987, and the break-even has been lowered as well. Then, what happens after that? Well, that 70 call expires on December 3rd. We have a lower strike put on our position. CF begins to recover and moves back above our new put. I want to take advantage of that ATM bell curve and stay in the right side of those 3 core principles. Our current put is the June 62.5 that we rolled to on November 30th when the stock was at 60.59. At that time, we paid $8.70 for the lower strike put, but about $2 of that was intrinsic. The time value was $6.79. Now, on December 17th, CF had moved back to 64.81. Our June 62.5 put is out of the money. It's all time value, but it's still priced at $6.40. We didn't lose much as far as the time value or extrinsic value on the position. And what is on the other side of the time value curve? The in-the-money 70 put with a stock at 64.81. Proper side of the ATM bell curve. And this would be income method number 4. We're going to sell to close the June 62.5 put for $6.40. That's all extrinsic value. We're going to buy to open the June 70 put at $10.80. But remember, with the stock at 64.81, about $5.20 of that 70 put price is intrinsic value we're guaranteed to get back. The rest of it is the time value. This adjustment pays a debit. It's one of the only income methods done at a debit. I'm paying $4.40 back into my trade, but I'm gaining $7.50 of guaranteed return. Now at the 70 strike. That's a fair swap I'm willing to make to control the risk. Well, where do we stand now? November 12th, we bought CF at 64.57. We initially bought the June 70 put at 11.15. Took in $1.05 for that income method number 1 that expired on the 3rd of December. We used income method number 9 to lower the cost basis. Then we moved the put back up in price to take advantage and be on the right side of the ATM bell curve. After all that, the current basis on the stock is 63.47. We own the June 70 put again, but now at a cost of 10.80, 35 cents lower than what we initially paid. This took our risk down from 7.7% down to 5.7%, even with the stock declining for a 2 to 3 week period while we were in the trade. But you're right, we're still not bulletproof though. However, CF continues up after that December 17th adjustment. On December 28th, CF is trading at 74.32. Income method number 1 again, why not? We could sell a 1 month out, standard January 75 call for $2.60. This cuts the risk down by more than half. We lower it from where we were at 5.7% down to 2.3%. Still have the potential to make double-digit returns if CF is trading right around 75 in the next 25 days or so. My put again is on the wrong side of the ATM bell curve, or on the right side. We're holding the 70 put. Stock was around 71 or so. On December 30th, it was 71.88. It's at the peak of the at-the-money bell curve. We could sell to close the June 70 put for 7.15. Why is that important? That put is now slightly out of the money. The 7.15 price is all time value. Remember when we bought the 70 put at 10.80 and the stock was at 64.81. We only had about $5.20 or so of extrinsic value we were paying into. Now that extrinsic value has swelled due to the ATM bell curve and is up to 7.15. We're going to swap that and could get back on the right side of the ATM bell curve by selling our 70 put, buying the 75 put for $9.90. Again, a debit of $2.75 to gain 5 more points of guaranteed exit, which does what? Puts our risk down to a negative value of 58 cents or 0.8% negative maximum risk, which means almost 1% of bulletproof status. Still have a potential for almost an 11% max return if CF continues up as we're expecting, and still have the ability to use other income methods to adjust that short call if needed. 5 income methods in about a month and a half took the position from a controlled risk to a lower risk even though the stock was declining, a lower break-even point, get some income along the way, take advantage of the 3 core principles and make sure we're on the right side of the ATM bell curve, and we now have a new bulletproof trade with still potential for double-digit upside profits. Was all of that math and all of those adjustments the best approach? Not necessarily. Remember, I could have done nothing since November 12th and still had an opportunity to bulletproof the trade today with not having done any prior income methods. There are different adjustments we could have done along the way as the stock was declining or as the stock had recovered. That's why there's 12 different income methods discussed in the blueprint. And even at that worst case scenario, when the stock was below 60, the position by itself with no income methods was never close to that full 7.7% loss on the position because time was on our side because we followed the 3 core principles. I don't need to time the trades because I am trading time with the proper structure. And that is what is in the blueprint. The blueprint teaches the application of the 3 core principles for that initial structure to keep you safe, force an ideal size trade, put time on your side, and take advantage of the at-the-money bell curve. A proper application of all 12 income methods, that SIGA decision-making process for each one, how to and how not to use each income method. A full chapter on combining income methods. We saw some combinations of income method number 4 and income method number 1 just a moment ago. A full chapter on exiting the position if your goals are not being met. Other examples, of course, and case studies to help you master these techniques and go forward into uncertain markets with the proper position size, forcing an ideal size trade, and putting time on your side. But remember, you want to act fast. Our special end-of-the-year offer for the Blueprint ends tonight at midnight. If you go over to radioactivetrading.com/EOY or go to radioactivetrading.com and click on the Products tab to pick up your Blueprint, you're going to lock in the special 8 bonuses that we offer at the end of the year. You'll get 2 months of Fusion for only $10 per month, and that'll give you access to the Fusion lessons, the RPM report, where you can find new trades, and the open positions, where you can see historical and current trades that we're using and how we apply these positions in our portfolio. You'll receive a bonus Mastery Series video, the Foundations of Radioactive Trading, and the bonus FIST video, 4 Insider Secrets of Trading. We'll send you the quick start guide to help you eliminate the guesswork about transitioning from covered calls or spread trading into radioactive trading as well. You'll receive 1 month of power options to help you find new trades, adjust criteria, and track and manage the positions in the portfolio. But you can take that whenever you're ready. You don't have to start right away. The Blueprint is now all electronic, so you get instant access. And you'll also receive email and phone support completely free. In addition to that, as a Blueprint owner, you also have instant access to members-only content, Blueprint owners-only webinars, white papers, and much more. And an additional bonus, the Blueprint comes with a money-back guarantee. It is a no-risk trade from the beginning. If you purchase the Blueprint, lock in your 8 bonuses, but you decide after going through a few chapters that you don't think it's right for you, it doesn't match your trading goals, just let us know. We'll refund your purchase price. Essentially, it's a bulletproof trade right there. But remember, this offer ends at midnight to lock in the 8 special bonuses, so you want to start controlling risk, having the ability to bulletproof your trades, the proper way to do the 12 income methods going into 2022, and tonight before midnight is the best time to get your Blueprint and lock in your bonuses.